Well, I think that we've really pulled ahead a lot of the rally that we've experienced in October and November. And I think that for many people sort of looking ahead to the next couple of weeks, what we're seeing is just a significant amount of repositioning, a reset and reallocate, if you will, in terms of what's already been achieved, if you will, in the past 2 months from an equity perspective, and where does we go from here. I think today's number is just indicative, I think, of the narrative that we've been struggling to invest against over the last 3 or 4 months, and that there are going to be fits and starts as it relates to economic data. Inflation is not going to be solved in a straight line. It wasn't created in a straight line, the issues that we have today. And so I think one of the things is just to take each of these data points and really look at it in terms of what the trend is. And I think the trend does continue to improve. But I would say a catalyst for continued gains coming into the end of the year would have been a remarkable PPI and CPI, and coming up to next week, a CPI improvement. And we probably don't see that given what we saw in the PPI today. So I would say we're probably going to knock around here on a pretty flat line over the course of the next couple of weeks. As you know, Scott, volume's going to fall off significantly, after the 20th or so. And I think that right now we're seeing a lot of institutional investors in particular getting themselves set for the end of the year and also looking forward to the first quarter, which could be another round of significant volatility.
So, Jason, Fundstrat's Mark Newton, and some have been pointing, like Josh did yesterday, to the respect that the technicals should be given. And maybe today's reversal is a signal in some respects of that. Mark Newton says, and this, by the way, this was put out last night before the PPI came out today. So let's put it into context here. The short-term pullback, he said this week, for U.S. stocks looks complete. Should be the beginning of a bounce, which likely carries into early next week ahead of CPI and the FOMC. Now, I don't know if, you think PPI reverses what he thought could happen, but maybe this price action in the market up till 12:06 and 30 seconds says something otherwise.
Yeah, I think that's possible, Scott. Obviously, if we were watching the futures market earlier, this morning and seeing them run, and then when we saw the report of the PPI numbers, and then we saw them pull back, and now we're positive on the day. I think, as I look at the PPI numbers as an example, they were warm, they were hot, but they weren't blazing hot. I mean, transportation costs have come down, energy costs have come down some. It's not always a read-through into CPI, what we'll see next week. And then we obviously, to your point, have a Fed meeting, and the commentary will be important. I think, there likely won't be anything said differently than Powell has said over the last couple of months. But I do think if we see a lighter number, we've seen the market reaction. So I could see here what Newton is describing to in terms of as a rally into year end. I think that's quite possible. But we'll have to see. Time will tell. I think the next couple of days will be very important to see how the market reacts.
Rob, what do you make of the reversal today? You had a decent tape yesterday. You've had, pretty decent breadth in the market under the surface from the mid-October lows. It's not all bad, and maybe it is better than it looks. And today is interesting, the price action alone.
Yeah, I think that's all positioning, to be honest with you. There's a tug of war between positioning and deteriorating fundamentals, across a number of things. What I would tell you is I had lunch with Lee Cooperman yesterday, Scott, and he's cautious like we are. And the one thing he pointed to as a positive catalyzer is that everybody's negative. I think everybody on this show today, all your traders have slightly cautious outlooks. And, we have to keep in mind that the Fed's going to keep at it until the job's done. And that's not fully appreciated by the markets. And that's because inflation is stubbornly high, and the terminal rate is likely going to be higher than the 5% that's priced into the markets. And so what we think is that sometime in 23, we're data dependent like the Fed, but the lows are going to get retested. The timing of that is uncertain. And, the reason we have caps to the upsides on these optimistic forecasts is that earnings are going to be in a tough position next year. Just look, you have many people now cutting their earnings. Let's just assume earnings stay flat. Right now, markets are pricing 6% earnings growth. But if they stay flat, we're at an 18.5 times earnings environment in a market where the Fed's going to likely have to stay engaged. If you go down from there and earnings actually get cut, which many pundits are now starting to embrace that idea, then we're trading even more expensive. So valuations act as a cap on these markets. And I think investors have to pay attention to not get too seduced by trading around positioning.